Hello, and welcome to Thinking Solo, where we talk about ways to succeed in business and in life. I am your host, Ryan DeRusso, and thank you for joining me today. I'm a fee-only financial advisor, and you can find me at thinkingcapfinancial.com. Today, we're talking about a very tricky subject, and that is taxes. I know it's not everyone's favorite subject, but when you are self-employed, building out estimated taxes is one of the most important parts of the job because you can go very quickly from feeling very flush in your business to very poor in your business if you're not estimating taxes correctly or considering the wrong things when doing so. And today, speaking generally, because I'm not talking about specific tax situations, I'm going to talk about ways that you can make sure that you're doing a better job of accounting for taxes along the way. First, the most important thing is make sure to start with profit, not revenue. This is where many business owners fall prey to thinking they are doing operating at a certain level when in fact they are not. I've talked to many business owners over the years who thought they had this huge business because it was $1 million in revenues, and yet at the end of the day, the business is operating at a loss. Well, then you're operating at a loss. You don't have a cash business that is really funding you. And so if you're seeing your personal life really struggle, your personal finances struggle because even with this $1 million business, it's because the business is not making any money. And so you might really need to make sure that you're starting with expected profit and not revenue. When you receive income from your clients and whatnot, what you then need to do is take out expenses and take out taxes and all that sort of thing. And that's where you get the profit. And really, profit is what taxes are estimated on as well. So if you're only focusing on revenues come tax time, you're not taking nearly enough deductions. I would say that's a pretty rare situation in that case. More likely is that you think the business is operating really well because you're considering the size of revenues, but then and you may not even be paying that much in taxes, which sounds nice, but in reality, you're not pulling a lot of cash from the business. And so therefore, the business isn't really operating for you while the business is operating maybe for your employees, if you have any, or, your clients are obviously getting something out of it, but they're not being charged enough. And so you're actually getting the short end of that stick. And so start with expected profit, not revenues. The second thing to do is account for self-employment tax. This is one of the bigger surprises when people begin is how much that they're going to pay in taxes because they haven't accounted for self-employment tax, which is really just Social Security and Medicare. And when you're an employee, the employer pays half of that. So up to a certain level, it's 15.3%. Half of that, 7.65%, is being paid by the employer. But you, when you operate for yourself, are both the employee and employer. And so having to account for that extra 7.65% sounds small. It's huge. And by the end of the year, it can be a significant amount if you haven't accounted for it at all, because what's happening when you're an employee is that money is slowly being taken out. And what happens when you first start operating or you first have your real big year is that money's not being taken out and you have to pay it all at once. And, that can be really jarring, and you want to avoid that as much as possible. And so accounting for that at the very beginning, when you're putting aside money for taxes, is going to be an important part of this whole process because, again, $100,000 made versus $100,000 salary is very different because the $100,000 made hasn't had Social Security and Medicare accounted for, whereas the $100,000 salary, that's going to be taken out gradually and your employer's paying a portion of it. And so you need to make sure that you're accounting for it every time you get paid, every time you're paying estimated taxes. One of the ways that, you've probably done this if you've been operating for a while is setting aside a certain percentage of every payment to taxes. This allows you to ensure that you are not just operating very thinly, and then come tax time, you just owe a huge bill that you can't afford. Instead, you're taking a small percentage, maybe it's 20%, maybe it's 30%, maybe it's 33%. It just depends on whether you have income tax at the state level or not, and then sort of what your partner is doing on a tax front as well. But the exact percentage may vary, but consistency is what really matters here, because every time you get paid, you're putting a certain portion over into a separate account or a separate sub account accounting for taxes. And this allows it to build, and you can pay at the end of the year. But what's better is to start paying on an estimated tax. So every quarter, paying when they are due estimated taxes. And the reason is because you are protecting yourself from that big bill. You know taxes are going to come, and you're going to have to eventually pay this money anyways. And while people like to store this money so it's like this extra buffer for them, in reality, getting rid of it can often be better, just because it's now gone. It's no longer part of the equation, and you'll adapt around it. And meanwhile, you're protecting yourself from not having to owe a huge amount at the end of the year or in April. And also, you don't have to worry about penalties in that case as well. So it's, for both reasons, it can be really valuable to do. The fourth thing is, make sure to review your numbers quarterly. This is particularly once you are really been operating and building and growing larger and whatnot, because the income is going to change dramatically year over year, but also quarter over quarter. And when we're trying to estimate out taxes, we need to find a number that's actually going to work for you. And one way we do that is through estimating on a quarterly basis. So it's important to compare your actual profit against your original estimate every quarter, and then just adjust along the way. But the only way to do that is to actually run quarterly estimates. That may require your tax filer doing it. It may require a financial advisor to do it, just because now we're getting a little bit more complicated with what we're doing. And so making sure that you are reevaluating these things on a quarterly basis is going to be really key for your long-term protection. And then that really leads to the final thing, which I kind of mentioned in the set aside a percentage every payment portion, but make sure to actually pay those estimated taxes, because it's too easy to just hold on to that money within the account. But it's going to pay off way more by actually paying the estimated taxes on a regular basis, just because you don't have to, like, something won't come up and they just take that away. Instead, you can manage whatever comes up through different means, but you're not like taking it out from the taxes, because you know that's going to be there. You know that's going to be due. That's not going anywhere. And so you might as well take care of that, so it's off the table, and then figure out other ways to manage other expenses. But also, by removing it from the table, you know how your business is truly operating. Because if if you're super short on cash and you have paid the estimated taxes, well, I would say you need to save more in cash in the business. And that means maybe paying yourself a little bit more, or looking at your expenses to figure out what you can change so you're paying less in those expenses, but ensuring that you're keeping more of the money. And so by getting rid of the estimated taxes and paying them on time, you can actually take a true assessment of the business as well. But doing all those 5 things is really going to make it a lot easier come tax time. And more importantly, you're going to pay less, because when you're late on payments or whatever, you're building penalties, you're building the amount you owe, you're building the amount of interest potentially that you're paying on these things, and it's going to make a big tax bill bigger. And by going through this process, you're actually getting rid of that, and you're saying, I'm not going to pay the penalties, I'm not going to pay interest, and you're just going to pay what you actually need to pay. And so you're going to be paying less over time. And when you're truly operating as a business, that's going to be so important. Today's movie review is a unique one, because it's a movie that, like my last movie review, it was a little new to me. I hadn't heard of it, but it's a cult classic named Repo Man. And it's from 1984. The director is Alex Cox, who I don't think went on to do a ton of other, maybe he did, but just not a ton of bigger movies. But it stars Emilio Estevez and Harry Dean Stanton, among others. But this movie follows particularly Emilio Estevez, but also the whole crew of Repo Men, as they're trying to go about life and trying to figure out the repo business. But also they're really targeting this one really big job, this one I think it was a Camry that needs to be repoed, but there's something, otherworldly about what's in the Camry, and that takes you down a path. But this is wild, cheesy. It kind of lacks definition, but it's also like super enjoyable and amazing and gross and ugly because it's set in the Reagan era. Cities and based, in a heightened version of the economies then. And so, it's playing on that as well. But as, entrepreneurs and self-employed folks, you would get a kick out of just trying to get started and going and trying to uh, build sort of a business for yourself, which is kind of what Emilio Estevez is doing. Meanwhile, there's some hilarity, there's some intrigue because of what's going on with the car. Now, the sci-fi graphics do not hold up, I will say. It's, I think, probably cheesy for the time. So I look at it as more intentionally cheesy than as opposed to poor execution. But yeah, if you struggle with that sort of thing, you may struggle with the ending here a bit. But otherwise, it was a very fun, interesting movie that was new to me. So definitely worth checking out. That's today's show. You can find me on YouTube at Thinking Solo. I'm on LinkedIn under my name, Ryan DeRusso. And you can also find my business at thinkingcapfinancial.com. Be sure to subscribe. I'll speak to you next time. In the meantime, keep grinding.